we have seen a number of proposals from private equity funds where the returns are really not calculated in a manner that, they're not calculated in a manner that I would regard as honest.
Warren Buffett has spent 60 years buying companies. He's made more money from acquisitions than almost anybody in history, and he thinks most of private equity is a scam. His criticism isn't about private ownership of businesses. It's about financial engineering masquerading as investing. In this video, I'm going to break down exactly why Buffett thinks that traditional private equity is broken. And more importantly, what he does instead. Whether you're running a fund, operating a holding company, or even searching for your first acquisition, these principles will change how you think about buying businesses. Before you can understand Buffett's philosophy, you have to understand what he's reacting to. And it's a phrase: 2 and 20. The standard private equity structure charges investors 2% every year and 20% on all profits generated. This sounds reasonable until you do the math. A $1 billion fund collects $20 million in management fees, whether they're good investors or not. Across 10 years, that's $200 million. The manager of the fund gets rich regardless of whether they deliver an outcome for their investors or not. Heads they win, tails they win even more. Here's what Buffett had to say at the 2016 annual shareholder meeting. If you even have a $1 billion fund and get 2% of it, for terrible performance, that's $20 million. In any other field, it would just blow your mind. And in a 2017 CNBC interview, he was even more direct. 2 and 20 is going to make a lot of people rich, and it's going to make very few investors rich. Think about what the structure incentivizes. If you're a GP, your incentive is raising the next fund. A bigger fund means more management fees. Performance matters, yes, but not as much as assets under management, especially in the short term. But misaligned fees are only part of the problem. The bigger issue is how private equity deploys capital. And that brings us to debt. If there's one thing that separates Buffett from traditional private equity, it's debt. PE loves leverage because it allows you to buy bigger companies with less money, meaning you get higher returns. Buffett, on the other hand, views debt and leverage as existential risk. For example, if you're a good private equity investor, you buy a company with 70% debt and it doubles in value. That means your equity actually triples. This is great when it works, but it's catastrophic when it doesn't. In his 2014 shareholder letter, Buffett addressed this directly. In truth, equity is a dirty word for many private equity investors. What they love is debt. But he's less so against other people using debt than he is worried about what happens if he uses debt himself. In his 2010 letter, he explains how this pans out. Any series of positive numbers, however impressive the numbers may be, evaporate when multiplied by a single zero. History tells us that leverage all too often produces zeros, even when it is employed by very smart people. For example, Buffett watched this play out in real time with long-term capital management in 1988. They had 16 PhDs, 2 Nobel laureates, and perhaps the most sophisticated risk model on Wall Street. But they ran 25-to-1 leverage. So when Russia defaulted on its debt, LTCM collapsed so fast, it almost brought down the entire financial system. Weeks later, Buffett gave a speech at the University of Florida.
To make money they didn't have and didn't need, they risked what they did have and did need. And that's foolish. That is just plain foolish. It doesn't make any difference what your IQ is. If you risk something that is important to you for something that is unimportant to you, it just does not make any sense.
So, fees create misaligned incentives and leverage creates fragility. But there is a third problem that affects every business buyer directly. It's how PE measures and reports performance. There are 2 accounting games that Buffett has called out directly. The first is IRR. Private equity firms calculate their returns based on when they deploy capital, not when the capital is committed. So if you commit $100 million, but they only deploy $50 million, that makes their returns look way better than they actually are. The second is EBITDA obsession. This number doesn't account for depreciation, which to Buffett is a real cost of running a business. Equipment can wear out, software needs replacing. These are real costs that a business has to incur to continue operating. Buffett put it in a much funnier way than I ever could. Does management think the tooth fairy pays for capital expenditures? Here's a simple way to think about it. Imagine you own a trucking company. Your trucks depreciate $1 million per year. EBITDA is, ignore that, it's a non-cash expense. But in 5 years, you actually need new trucks, and that becomes real money leaving the business. EBITDA lets you pretend that that doesn't actually exist. So that's the case against traditional private equity. Misaligned fees, dangerous leverage, and misleading metrics. But criticism is easy. So what's the alternative? That's where Berkshire's model comes in. Every year in their annual report, they list the 6 criteria that they care about when buying a business. And if you understand these, this allows you to understand why Berkshire wins where traditional private equity can't. Here are the 6 criteria. 1. Large purchases. 2. Demonstrated earning power. And he's explicit. Future projections of no interest. And no turnaround situations. 3. Businesses earning good returns on equity while employing little or no debt. 4. Management in place because Berkshire can't supply it. 5. Simple businesses. If there's a lot of technology, they won't understand it. And 6. An offering price. They don't like competing in auctions. The second item is perhaps the most important. Demonstrated earning power and explicitly no turnaround situations. This is interesting because a lot of private equity firms promise operational value add or value creation. And even Buffett in the early days had a different strategy. Early in his career, he was a cigar butt investor. He would buy failing companies that were cheap and extract the last puff of value. Charlie Munger, his business partner, was able to change his mind. Here's how Buffett describes it. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And the defining example here is See's Candy. Buffett bought it in 1972 for $25 million. At the time, it earned about $4 million pre-tax, so this was quite expensive. But See's had something far more valuable than cheap earnings. A brand moat. Customers paid premium prices year over year. The business required almost no reinvestment. Over the next 50 years, this resulted in over $2 billion in pre-tax profits. Profits that Buffett was able to redeploy into other acquisitions. The key lesson here is that it's easier to buy a great business, rather than buying a bad or okay business and hoping to change that. As Buffett once said, "We've observed many kisses, but very few miracles." This was when he was referring to buyers who expected to turn toads into princes. But finding businesses to buy is half the battle. Once you've found a great business, you actually need the capital to buy them. And this is where Buffett's approach differs most sharply from private equity. And it comes down to how you think about cash. In traditional private equity, cash is a burden. It drags down IRR, LPs get impatient, and there's pressure to deploy. But Buffett sees it the opposite way. Cash is actually a weapon to wield. Berkshire typically holds $100 billion plus in cash or cash equivalents. Most fund managers would consider this insane. That's dead money, earning nothing while the market compounds. But Buffett considers this essential. He's waiting for chaos. Here's how he described it in the 2017 shareholder letter. Every decade or so, dark clouds will fill the economic skies, and they will briefly rain gold. When downpours of that sort occur, it's imperative that we wade into them carrying washtubs, not teaspoons. And from 2010, by being so cautious in respect to leverage, we penalize our returns by a minor amount. Having loads of liquidity, though, lets us sleep well. Moreover, during the episodes of financial chaos that occasionally erupt in our economy, we will be equipped both financially and emotionally to play offense while others scramble for survival. And he did exactly this in 2008. When Lehman collapsed, every over-leveraged fund was selling assets at distressed prices. They had to. Their lenders were calling and their LPs were panicking. Buffett, on the other hand, was on a shopping spree. In 25 days following the bankruptcy, he deployed $15.6 billion into Goldman Sachs, GE, and other companies desperate for capital. And the terms were extraordinarily favorable to Berkshire. He got preferred stock with 10% dividends plus warrants. But he could only do this because he had cash, no leverage, and no panicked investors. But cash is only useful if you can deploy it. And that's where Buffett has another edge. He doesn't compete on price or compete in auctions. He offers something that traditional private equity funds structurally cannot. He offers sellers permanence. Many founders care about what happens to their businesses after they sell. They care about employees, culture, and legacy. But PE funds have a structural problem. At some point, they have to exit, and the business then becomes merchandise to be flipped. Berkshire doesn't have that constraint. When they buy a business, they can hold on to it forever. Here's Buffett's words directly. Berkshire offers a third choice to the business owner who wishes to sell. A permanent home in which people and culture of their business will be retained. The lesson for holding company and long-duration funds is this is an edge, and you should lean into it when you're pitching founders. But winning the deal is just the beginning. What happens after you close? How do you actually manage a portfolio company? And this is where Buffett's approach might be the most counterintuitive of all. Traditional private equity has a playbook. Install new management, bring in operating partners, and run a 100-day plan. Stabilize, optimize, and then improve. Buffett does the complete opposite. He calls it delegation to the point of abdication. Berkshire owns businesses that employ more than 377,000 people. but their HQ has only 26 people. That's because Buffett doesn't run his portfolio companies. He hires people who can run them, and then he gets out of their way. In the 1999 annual shareholder meeting, Buffett said,
We've got some absolutely terrific people, and we are knowledgeable enough about that so that we don't go simply by a bunch of figures and make a determination whether people are doing the right thing. So we're knowledgeable owners, and we have no one whose job at headquarters is to go around and tell our managers how to run their human relations.
This only works because of how Buffett buys. If you recall his criteria, he buys businesses with management in place, demonstrated consistent earning power, and no turnaround situations. He's not buying businesses to fix, but rather buying machines that already work. If you're hearing this and your model requires heavy operational intervention, you're playing a different game. And Buffett would argue a much harder one. So we've covered why Buffett doesn't like traditional private equity and how Berkshire operates in the anti-private equity model. But there is one more piece, and it's a lot more subtle. It's the math of holding forever versus flipping. What does exiting a business actually cost? Every time you sell a business, you trigger capital gains tax. You also trigger transaction fees from bankers, lawyers, and consultants, and even more in search costs to find your next investment. Each of these compounds in the reverse way that you want. Every dollar lost to these frictions is a dollar loss that you can't compound forever. Buffett has a test that he applies to every dollar that Berkshire retains. It's the $1 test. Every dollar kept must retain at least $1 of market value. If it can't, they return it to shareholders. If they can, they let it compound in the Berkshire structure, tax-free. Imagine you have two investors. Investor A buys a business, holds it for 5 years, exits, and then repeats that a couple of more times for 25 years. Investor B buys a business and holds it for 25 years. Assuming identical pre-tax returns, Investor B ends up with way more money. The reason is that there's no tax drag, no transaction costs, and no redeployment risk. They're able to compound uninterrupted. The traditional private equity model forces exits and creates this friction because of structure. But if you have a holding company or permanent capital, then you have a structural advantage. You're able to just compound these companies forever without triggering these transaction or tax costs. If you want to see somebody that did the opposite of Buffett in the early days, had some success, but decided that the Buffett way was still the best way of doing it, you'll want to learn about Alex Hormoz's Acquisition.com. He started by buying minority stakes and being extremely operationally involved. But to see how he changed his mind and why, you'll want to watch this video next, where I go into more detail.